Salutations, 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 everybody. For those who don't know who I am, my name is Timothy Lee Rogers Sr., and I'd like to welcome you to Learn to Trade Futures with yours truly, Lil Timmy Rogers. Again, my name is Timothy Lee Rogers Sr., and I'd like to welcome you to Learn to Trade Futures. This is Part 5, Part 5 of the series. If you have not watched Parts 1, 2, 3, or 4, please go here and watch Parts 1, 2, 3, and 4. Then come back here and watch Part 5. Now, again, I will be using slides that I have screenshot directly from ICT's core content. You do not have to trade ICT concepts to learn how to trade futures, but I advise you to always understand where price is trying to go. Because if you don't know where price is trying to go, when do you buy and when do you sell? Are you just guessing? Are you just guessing? Let's get into it. So, learning to trade futures, Part 5. Let's get into it. This is important to always know. Price will always seek balance and liquidity. Right? As it's seeking balance and liquidity, it will just chop up and down. Price will just range. When price is in a premium, it will seek to move to a discount. Price is in a premium, it will seek to move to a discount. When price is in a discount, it will seek to move to a premium. So what do? You analyze the price and you see, hey, we're in a premium. I anticipate price to want to seek out a discount. You do not want to try and guess when that will happen. You want to wait for something to cause an imbalance. You want to wait for something to start to cause an imbalance. What's an imbalance, Tim? An imbalance is a one-sided move where it's not just chopping back and forth. It's a one-sided move in the direction you anticipate price to move. Here, price was at a premium, and then price has started to move to a discount. What caused this move? It don't matter. It can be a news event. It can be, I don't care what it is. You just want an imbalance to come into the market. Don't try to guess when this is going to happen. You want to wait for time and price to align. You want time and price to align to cause this move to start happening. The market is in a premium. You anticipate it to go to a discount. You want to wait for time and price to align to move market from a premium to a discount. And just flip it on its head for the reverse, going from a discount to a premium. Just flip it over. Same thing. It works both ways. Trust me, it does. Right. You do not know how much time it's going to take for price to come to where you anticipate it going. You don't know how much time it's going to take for this to play out. So what do you do while it's playing out? You want to study the price at particular times to see if you're still on the right side of the market. Well, Tim, what are these times? ICT call them kill zones. During these kill zones, you want to study price. The kill zones are during the Asian time frame, during the London time frame, during the New York morning, during the New York afternoon. It's certain kill zones. It's certain times of day when the algorithm is most active. It's most likely for the ICT concepts to play out. That's why you want to study during those times and see if you're still on the right side of the trade. Well, Tim, how am I going to study? How am I going to know I'm on the right side of the trade? I'm glad you asked that question, little Timmy Rogers. We ain't seeing you all series. I'm glad you popped up. You study it. Now, if you're using ICT concepts, this is very important to you. If you don't use ICT concepts, just relate what I'm saying to the stuff that's on this slide right here. In between premium and discount, from the highest high to the lowest low, 50% in between. For those who don't use ICT concepts, 50% between the highest high and the lowest low. That's what is called equilibrium. At equilibrium, the price can go, the market can move in either direction. You're in between the tale of two cities. It can go either direction. So you don't want to force your opinion on anything. So at equilibrium, who remember Ant-Man? For the True Blue Gang members, we had a little character called Ant-Man. And when Ant-Man is standing on equilibrium, he looks up through the price, and as he's looking up, these are the PD arrays he's gonna come across. All of them are not going to be present at the same time. There can be multiple, but they're not all going to be there. And when he's standing on equilibrium, he looks down, and these are the PD arrays that he looks down at. Notice, they're all the same PD arrays, but it's just down here, they're bullish, and up here they're bearish. Meaning, when you look up into a premium, you're looking to sell. You sell in the premium and you buy in a discount. So if you're bearish, you want price to come up into a premium, and you identify the PD arrays that's present, and you're looking to sell off of those. If you're bullish and you're at equilibrium, you look down at price and you look for the PD arrays to buy off of. That's how you study the price going through the time to see if you're still on the right side. From equilibrium of a price move, price will move up into a premium. And as it comes to these different PD arrays, this is the order of importance. The old high or low is at the top, because when you reach an old high or an old low, yes, you can reach an old low by going up, because if you're in a deep discount and you retrace very high up through price, far to the left, you may be running into an old low. But when you get to the high, that's the furthest point in that price leg. Remember, I told you the highest high to the lowest low of your price leg. This is your premium, this is your discount. So when you get to the highest high, you're getting ready to get outside of the price range. So as you're going up through price, you're going to look for mitigation blocks. There's no mitigation block there. You're looking for breakers. There are no breakers there. You're looking for liquidity voids. Now, one note about liquidity voids. Back when ICT started teaching this, the liquidity voids that he was mentioning in here is actually just imbalances, buy side or sell side imbalances. You have big extended moves where it's just all buy side delivery or all sell side delivery, and that's what he was calling the liquidity void back then. Even though he said it wasn't a real liquidity void, he was just using the term for that. That's what Baby Pips wanted, so that's what he gave him. A real liquidity void is an actual gap, no price in there. Now that I've beat that horse, look for fair value gaps, look for order blocks, then you got rejection blocks, and then the old high. If you don't know what those terms mean, go look at the core content, or you can look at my ICT Concepts Explained lingo playlist, and it'll tell you what each one of these PD arrays are. So, and you can also, there's another way you can use these. Instead of just selling off of the premium and buying off of the discount, you can also use them to, if you can use them as targets. Meaning, if you're bullish and it comes down into a discount and you buy off of a bullish breaker, you can target a bearish fair value gap to get out of, or you can target a bearish order block to get out of your trade. You can use them as targets too, because depending on the time frame that you're coming up on in the premium of this PD array, it may be strong enough to reverse price on you. So you always want to be mindful of what time frame the PD array you're approaching if you're in a position. You want to be aware of that. You want to be shaving or closing your trade as you approach the opposite end of the spectrum, meaning coming from discount to premium or from premium to discount. You always want to be aware of that. Now, let's get into your homework. Your homework is to use the ES chart. I've already started it for you. You're going to use the ES December contract to analyze price on the monthly, which I've already done for you, and I'll explain what I've done, the weekly and the daily. And you're going to look at how price was moving from August until now, right? If you remember the lines for the market price and the future price that we had on the slide in the beginning, right? We're using the benefit of hindsight because we see that it has already delivered to the future price. But what you're going to do, I want you to go back through price and see how price delivered down here. Now, let me break down what I did on the monthly, and then that way you'll know what to look for on the weekly and the daily. And for extra credit, you can take it all the way down to the intraday time frames that you use. Let's pull up my trading view chart so I can break down what I've done here, and then you'll understand your homework more clearly. Here we are on the monthly chart for the year. Matter of fact, let's do it like this. Let's come back here and take away August through the future so that you can get a clear view of what I'm trying to show you. Now, this is the market price at the end of July, and this is the future price that we anticipate. Why do we anticipate this future price? Because price has rallied to a premium rejection block over here. We got a premium rejection block over here, and price has rallied up to a monthly premium rejection block. Why did price rally all the way to the rejection block? Because there's no clear PD arrays in price action in this price leg down for price to rally to. Remember, you look for from the mitigation block all the way up to the old high or low. In between there, no mitigation blocks, no breakers, no liquidity voids, no fair value gaps, no order blocks. Only thing we have is a rejection block and an old high. So we rallied all the way to the rejection block. There's an old high also. Rallied to the rejection block and stopped. Now we're at the rejection block and we're anticipating price to come back down to the discount. What do we have to come back down to on this move up? We have a bullish fair value gap that price can come back to. We have a order block, a bullish order block here between the August and the September candles, and we have a bullish breaker here on the July candle. So we can anticipate price coming back down. This is the future price we're anticipating. This is the most likely area to come to. Why? We have a bullish breaker down here, and in the order of importance from the PDub chart, if you remember, the bullish breaker came before the fair value gaps. So we can anticipate price trying to make its way to this bullish breaker. It doesn't have to get there, but we can anticipate it. It's more likely for it to get to the breaker because the breakers has a higher level of importance on the PDub chart. So in this monthly anticipation of price coming to this future price at this breaker, we came down, had a reaction off of the monthly fair value gap, and then eventually came all the way down to the breaker in the discount. So price rallied to a premium rejection block, retraced to the fair value gap, bounced, then eventually retraced down to a discount PD array, and now price is at the future price. So what will you do with this? I want you to go through the weekly and the daily and look at the same time frame from August down to the present and see what PD arrays price came up to on the weekly and what PD arrays it came down to on the weekly, and in between, what was the reaction off of weekly PD arrays. Then do the same thing with the daily. It came up to what daily PD array in the premium, and on the way down, what daily PD array did it come down to, and in between, what was the reactions off of the PD arrays in between on this price, on this expansion price leg on each time frame you go to. And if you take it to the intraday with the extra credit, continue to do the same thing. So hopefully you enjoyed the fact that this was a short one. Now, make sure you go and do your homework so that the concepts will start to stick. You'll start to see how it plays out in price. That's the most important part, seeing how it plays out in price. Everybody think it's just this magic wand where if I got this one thing or if I got this, no. It's a combination of all the things that helps you understand how price is being delivered. So, until the next one, man, y'all be safe out here in these trading streets. Gone.